We're back with Steve Smith, CEO of Equinix, and what a year it has been. Last time we spoke in June 2012, the stock was at the 170 level. It's at 215 right now. Earnings look great, revenues look fantastic. Where's this growth coming from?
Well, most of the growth, Jill, is coming from the general growth of the internet and IP traffic and all these mobile phones that we carry around and cloud computing and big data. So all these big technology trends that we all read about and hear about, we pretty much play at the intersection of all of these trends because the data centers that we have around the world, we have about just under 100 data centers in 31 markets around the world. And most all those trends require servers and storage arrays and networking gear to make all that stuff work. And
right.
We are well situated.
And you're continuing to grow because I just read an announcement that you opened up a new data center in Seattle, the IBX.
Yes, yes. We call them IBXs, International Business Exchanges, because we do a lot of interconnection inside of these data centers. So last year we spent almost a little over $700 million on 21 projects. So we have capital going in multiple markets throughout the year. We'll do the same this year, although the guidance we've given the street this year is between 550 and 650 million. But generally speaking, the trends that you asked me about are driving the demand for this type of data center space, and we are in a very good position because we're in the right markets. We have very high premium service, and we have a brand recognition that companies feel comfortable putting their IT equipment with Equinix.
And where's the competitive advantage? Why Equinix?
Well, the biggest advantage is we're global. So we have, if a company wants to deploy stuff in China, Singapore, Frankfurt, Paris, New York, and LA, we have assets in the biggest markets in the world where the internet transacts. So we are located where the cable landing stations that underpin the internet work. Our data centers sit on top of the most internet dense locations in the world. So if you're a customer and you want to deploy your IT infrastructure out near your customers or out near your people, when you look at a map, we have 100 choices. And so we can very easily meet a requirement for a customer. So that's a big factor we have. And then the other big factor is we have more networks connected into these data centers. So if you are an electronic trading venue and you want to trade applications very fast, we are very attractive to do that. Or if you're a cloud provider like an Amazon or a Rackspace or a SoftLayer, and you want to get access to a whole bunch of customers, you can put cloud nodes all over our data centers and customers can very easily connect into them.
So let's shift back to Wall Street. Many analysts out there reiterating their outperform ratings, which is fantastic. We had another analyst launch just last week with an outperform. One thing they're speculating on is the status of the company becoming a REIT in 2015, some think maybe 2014. I realize you can't comment on that speculation, but why a REIT? Most people associate apartments, housing with REITs. Why a technology company?
Well, there are a lot of data center businesses today that are a little bit different model than we have. They're referred to as wholesale data centers. So they are larger real estate oriented, pure real estate oriented versus our data centers that do a little bit of interconnection and some other things. But we looked at all the options as we're becoming a taxpayer as the company matures. And we determined that we can continue to grow this company at the pace we've been growing it and take advantage of the tax benefits of a REIT structure. So we looked at it very closely. We think most of our income does qualify for REIT category, and today we've submitted to the IRS and we're waiting on a response. This is a very long process. That's why we picked January of 2015. There's a lot of work you have to do to get ready to become and report as a REIT. But the bottom line for us is that we could still grow the company strategically at the growth rates we wanted to and take advantage of the structure for global tax optimization.
And many analysts also expect that we're going to see an increase in CapEx spend in the back half of 2013. Didn't see quite as much as we thought we'd see in the beginning. What are your thoughts in terms of technology spend?
Well, our CapEx spend is down a little bit this year from where it was last year. We had a very big build year last year, so we did spend quite a bit of capital. But I would say the range that we've given in our guidance this year is, we feel pretty good about that, and we've predicted that for the year. But we've spent in this company in the 14-year history just in excess of $7 billion of capital acquiring and building the next phase or building the next data center in a city where it's filled up. So we are a very capital intensive business, but it's all driven by the customer demand. So we're very fortunate that, back to your original question, we play at the intersection of all these trends. We have a great reputation, we have a great brand, we're global, we have very high reliability, and customers like that.
Well, that's what we like to see, investing in growth and creating shareholder value. Thanks, Steve. Always great to see you.
Good to see you too. Thank you.